Tokenization is exploding right now. Everyone is working on putting assets on chain, whether it's equity, funds, debt, real estate. But here's the problem. The SEC has just made one thing very clear. Putting something on the blockchain does not change what that thing actually is. If you're building in tokenization and you miss this, you're creating legal risk at scale. Hey everyone, I'm Corey, a lawyer helping entrepreneurs decode law, technology, and innovation. This is part 5 of our 8-part series breaking down the SEC's new crypto framework. Today we're talking about tokenized securities, why on-chain doesn't mean outside securities laws, and what founders and entrepreneurs need to get right from day one. So here's what we're covering. What the SEC means by a tokenized security, why blockchain doesn't change legal classification, where founders get this wrong, and how to build tokenized products the right way. So first, what the SEC means by a tokenized security. The SEC defines a digital security as a traditional financial instrument like equity, debt, or fund interests, but represented on-chain. That's it. If it's a security off-chain, it's still a security on-chain. The core principle, the format doesn't matter. And this is the most important takeaway. The SEC is saying that technology does not change the economic reality. So equity doesn't become a commodity, debt doesn't become a utility token, and securities don't disappear because they're on blockchain. So tokenization is infrastructure. It's not a legal strategy. A lot of teams get this wrong. They treat tokenization like a workaround, but it's not. What tokenization is about, it's about faster settlement, programmability, better distribution, but it's not about avoiding regulation. So here, the rights alignment is where most teams fail. And this is where things get serious. The SEC has specifically warned that token holders may not have the same rights as traditional holders. That creates risk because you now have a mismatch between expectations and reality. You have potentially confusion around ownership. You have potentially problems with governance and distribution. And also, not all token models are the same. So the SEC points out that some tokens are issued by the original company. Others may be created by third parties. That means rights can be completely different depending on the structure. So the words tokenized security isn't really one thing. It's multiple structures with different legal consequences. In this case, adding utility doesn't fix the issue. Here's another major misconception. Some entrepreneurs or builders will think if we add perks, if we add access or governance, then it's no longer a security. That would be wrong. The SEC is clear that if it has the economic characteristics of a security, it stays a security. Even if you add access features, governance rights, platform perks, that won't change the analysis. So why does this matter for real-world products? This impacts everything. Tokenized funds, on-chain cap tables, real-world asset platforms, or even structured products. Because now the question becomes, are you building compliant infrastructure or are you just repackaging risk? The real strategy here is compliance by design. And this is where the opportunity is, frankly. The winners won't be teams trying to avoid securities laws. They'll be the ones building compliant tokenized products with clear rights, control transfers, and proper disclosures. Tokenization done right is scalable infrastructure. What are some of the big hidden mistakes? Treating tokenization as branding, I would put as number 1. Saying that we're on-chain, we're real-world asset enabled, or we're tokenized without answering the real question. What exactly does the holder own? If that's unclear, everything else breaks. So what should a founder, an entrepreneur, or builder in this space generally do now? Start simple. You need to ask yourself, is this a security in substance? Do token holders have clear rights? Do those rights match the legal structure? Are transfers properly controlled? And most importantly, are you building for compliance from day one? Here's the bottom line. Tokenized securities are still securities. Blockchain technology does not change the classification. Rights alignment amongst the holders of tokens is going to be critical, and tokenization is infrastructure. It's not a loophole. The future in this space isn't regulatory avoidance. I think it's going to be better and compliant market design. Join me on the path to decoding law, technology, and innovation to grow your business. Don't forget to like, share, subscribe, and hit that notification bell. Until next time.